Well, it's been a big year, hasn't it? Both for the world in general and for the captive industry. And today we are coming together to look at our second in the Captive Review Formation series, Planning Your Captive, the Journey to Forming a Successful Captive. For those who don't know me, I am Lauren Ingram. I am the editor of Captive Review, and I get to very luckily host this wonderful panel today, talking about the kind of key steps when you're forming a captive or planning a captive. So we have Derek Freihaut from Principal and Consulting Actuary at Pinnacle Actuarial Services. We have Farah Jaafar-Crossby, the Chief Executive Officer at Labuan IBFC. We have Pete Kranz, who's the Executive Managing Director and Captive Practice Leader at Beecher, Carlson. And we have Robert Quinn, who is the Vice President at Wilmington Trust. So we have a really great range of people here who can give some really interesting views on our topic today. So thank you all. And I think with that, we should probably jump in, everyone, because this is a big topic. And I know that you all have a lot of expertise and a lot to say in this area. So when you decide to form a captive, you know, the first step is obviously a feasibility study. But once you have that and you've gone through some of those earlier steps and decided you want to move forward with some form of captive, there are a lot of different service providers and experts that will help you through the process. And so I want to ask all of you, since you all do come from different areas of the captive world, what are those different service providers and what are the different things that people provide you with at this step? Because I think for some people, you know, if you're first coming into it, it can be a little bit confusing. So Pete, I'll start with you, since you do a lot of consulting and things like that as well. Yeah, what are the essential steps? And I guess, like, what do you do when you're as your little kind of cog in the part of the big captive industry?
I appreciate the question and also appreciate the opportunity to be chatting with everybody with this esteemed group. So I break it down sort of into three groups, possibly four, I'll say steps, sort of the pre-feasibility, feasibility, application, and then ongoing management. I know you're focused sort of on the formation, but it sort of grows over time. So when you start with your pre-feasibility, it's typically the broker that's involved and then the captive manager and consultant. And I say manager and consultant because there are some managers that are strictly managers and that are managers and consultants that will get into the feasibility and strategy as well. So that's sort of your pre-feasibility. Then when you move into feasibility, you're going to have your manager consultant as well as actuary and possible tax if you're going to have the transaction reviewed from that standpoint. And then you're going to have your insurance broker involved and possibly reinsurance broker depending on the captive structure. Then when you move into the application phase, you're still going to have the manager, the actuary. Now you're going to bring in legal counsel for organizational setup. And then one of the other partners that's going to be involved is actually the regulator, who is a partner in the entire process. And then when you move into ongoing management, and as you'll see here, it kind of continues to expand. As you have your manager consultant, you then have your actuary, you have your legal, you have your regulatory, but you start adding on banking and investments, claims handlers, and you still have your insurance and or reinsurance broker. So it sort of grows over time. And it's very important to have the right partners that fit for the right company. So.
But I think, you know, as you mentioned, Pete, the regulator is a real partner throughout the whole step. It's not just someone you go to at the end and you know, submit your documents to. They help you the whole time. So I think, Farah, you know, it's probably from your perspective, I guess, what is the regulator doing in this process and how are they supporting the formation?
Thanks, Lauren, and hi, everyone. For me personally, it's a bit like having a village raise a child. It's not as simple as just slapping one on when you need better coverage or when the markets are too hard. I think it's important to understand that the regulator plays a very important role because this is a wholesale risk intermediation entity. It's not just a slap on, as I said earlier, entity. So in Labuan, what we do is we take a very bespoke approach towards our license holders or potential license holders. And I think a lot of successful jurisdictions way ahead of us have done this for a long time. what we do is we engage not only the managers, but we engage potential risk managers, insurance managers, i.e. the people helping the risk managers in entities coming on board to set up captive. But we also help those risk managers directly in trying to understand their risk profile, what they need, as Pete was talking about. The other thing is, I think pre-consult is essential. Pre-consult in trying to structure a bespoke entity. When we talk about captives, it's actually very misleading. Captives is only just one form of self-insurance. So what's important to understand is that there's a whole myriad of different forms and structures that you may be able to use, like a cell or an association captive. And this is where, although in the example that Pete was giving, the regulator comes in almost halfway, it's important to try and understand the domicile, not necessarily the regulator at get-go, but the domicile to match what you need, if that makes any sense. Pre-consult, an approval in principle, or a nudge in one way or other. Again, as I said earlier, this is a very bespoke risk management, strategic risk management vehicle, and it requires a very bespoke regulator.
And Derek, what is, I guess, your place in this, and what's your view in terms of when people come in and what help you can give?
Yeah, so as Pete noted, the actuary often comes in during the feasibility study. And I was glad that Pete mentioned us early in the process, because sometimes the actuaries always feel like we're the last to know. And we've already talked about, I think, the feasibility previously, but that they come in with a funding study and looking at pro forma financials projecting forward and so forth. But from that process moving forward, the actuary is involved in annual funding estimates thereafter, reserve analyses, certifying the reserves for the regulators where necessary. And the key part about those relationships, those are the kind of the formal things they do. But it's important for the actuary that they're documenting everything that's happening and that they're communicating everything that's happening, because oftentimes, along with that funding study or along with those reserve studies, the actuaries are going to be part of answering any questions that do come from the regulator or that do come from the auditor about what's involved in premium projections, held reserves, and so forth.
And I mean, Robert, obviously, I want to bring you in because you also have a part in this, but it's a little bit different in some situations.
It's funny that Derek said that the actuaries are often the last people to know, because I can tell you for sure the reinsurance trustee is always the very last person to know what's going on. We get called at the last minute, but I will say this, that when it comes to these captive formations, one of the things that captives should be thinking about, hopefully sooner than later, is the amount of collateral they're going to have to post. And the fact that they have to post collateral, they have one of two or three different ways of posting collateral, and one of those ways, or two of those ways really, can save the captive, depending on the size of the collateral amount, possibly the entire cost of the captive management fees themselves. And so it's something that they should really look at earlier than later, because when you do these things at the last minute, then you're forced to rush. And when you rush, as we all know, you don't do the most efficient thing, you just do the most expeditious thing. And that can be a little frustrating for all parties.
Yeah, Lauren, if I can kind of tie one thing back here. So I appreciate both Robert, Farah, and Derek's comments about sort of where I mentioned each of those folks. And it's interesting from Robert's perspective, mentioning collateral and that's certain the broker, reinsurance broker should be brought in earlier, right, or the reinsurance trust or what have you, because really when you're on the front side of this, you need to be looking at what your program structure is going to be. And when you're thinking about the feasibility, if I'm doing a feasibility study, working with Derek's team on the actuarial, kind of putting the whole program structure together, I do need to look at collateral, as Robert mentioned. I need to look at the structure of my collateral. Is it going to be a letter of credit? Is it going to be cash? Is it going to be, are we going to try to do a working trust? And so having all the right partners involved from the beginning is key to a successful captive structure.
And what we've all mentioned here, and especially what Farah spoke about, really leads into what my next question was going to be, which is on, choosing a domicile is something that does have to happen quite early, because they have to, you have to partner with them the whole time. And obviously it's a very big decision, and it can often be a little overwhelming. And obviously you can narrow that down a little if you already know what kind of captive you want. As Farah mentioned, certain domiciles might not offer the structure you want. But what is the most important thing to know? And I'll head to you, Farah, first as a regulator.
Where to start? I mean, I think anyone wanting a captive will first look at the solvency requirements and go, too expensive, don't want that. Open regulator, yes, that's great, but if it's going to cost too much, I'm not interested anyway. And one of the things that I think we need to start looking at very, very carefully, and this hit the captive industry 3 years ago with BEPS 1.0, and now it's going to hit again with BEPS 2.0, is the ESR requirements, the economic substance requirements, and making sure that those requirements do not necessarily become too heavy a burden. So you've got a solvency issue. I mean, on the basis, to give credit to all the regulators out there, on the basis that all regulators want the business, are friendly, understand the business, have an entire ecosystem. Now, I think going back to that village example, an entire ecosystem within the domicile is important. And that's why I think you find a lot of domiciles that are actually full service domiciles do a little bit better than other domiciles, because you're going to want your bank account there. You're going to want to be able to hire people necessarily, right? It all feeds into this ESR requirements as well. And then on top of that, you have solvency. So I'm not looking at it from a pure regulator pitch point of view. I'm looking at it from a risk manager's point of view with regards to cost of having one of these vehicles. And I think the ESR requirements and solvency requirements are key in choosing, not so much on the basis that the regulators all rank pari passu, because everyone's going to want to be friendly. Everyone has a bespoke piece of legislation. Maybe some of us, like Labuan, have an added edge because we have a cell structure, the only cell structure in Asia, that kind of stuff. But at the end of the day, on the basis that everyone ranks equal, you're going to start looking at solvency and tax issues. And the fact that you're going to be able to need to reduce that cost to be able to access service providers that this captive will require in order to grow.
Pete, what's your kind of view on this in terms of, because you're obviously advising captive owners and potential captive owners of their options when it comes to a domicile. So what are the things you're thinking about when you're putting something together with a feasibility study?
Yeah, I think Farah actually hit on a number of them. From there's a couple different perspectives we have to take, which is domestic versus international. So a lot of the things Farah mentioned, economic substance, BEPS, and I'm not sure, Farah, if you guys have the implications from Solvency II, but we have Solvency II. No. Yeah, so we have Bermuda.
Not yet.
Equivalence, not yet. And that's part of, we've got the OECD and sort of anti-money laundering and a whole bunch of things that factor internationally. That's not to say that those are some potential, say, challenges there, but you have some potential challenges in domestic domiciles as well. So as you're running through, it also depends on, where is the ultimate parent of the captive located? Is it a US company? Is it a non-US company? Is it a global company based in the US where you might have significant Asian operations or significant European operations? When you think about the EU it might make sense to have a captive domiciled in an EU or an EEA member state in order to directly write those risks, but you also have to come back and weigh and see, do we want to do that and then be faced with the implications of dealing with local country laws and local requirements that we need to deal with, or do we want to use a fronting carrier, which kind of opens up the domicile too? So there's a lot of different things that factor in the specifics of each domicile. There are some jurisdictions, for example, that don't allow loan backs. There are some that allow loan backs, but it may not be considered a relevant asset for solvency. So to Farah's point on solvency, we have to look at those sorts of things. We have to look and see, what is the domicile's approach? Again, Farah, I think you hit on a lot of these items. Does the domicile offer sales? Does it offer groups? Does it offer those types of things? Or does it focus on pure captives, which some jurisdictions out there do? So there's a lot of these different factors. I think from a US company perspective, we also have to consider, are we direct writing or are we fronting? And if we're direct writing, do we have direct placement tax issues as a result of the Non-Admitted Reinsurance Reform Act? If we're looking at a US company with a non-US domicile and non-US taxpayer, do we have federal excise tax issues? So there's a lot of different things that we need to look at. And then when you've kind of boiled through those and come down to your sort of your equalized domiciles from that perspective, again, I think Farah did a great job of hitting on the specifics. Is what's the maturity of the domicile? What's the consistency of the domicile? How quickly do they respond to things? What is the service provider infrastructure of the domicile? So I think it's definitely a lot of different. It's not really as simple as saying, oh, it's domicile A or domicile B. There's a lot of considerations that come into it.
Derek and Robert, is there anything else you want to add to this in terms of when picking a domicile and things to think about?
Sure, I will. Most people know that I specialize in collateral, and so when we're talking about collateral for these programs, the litmus test for trusts and letters of credit and all the different types of collateral are New York state law. And so if whatever collateral mechanism you're using passes New York state law, then generally speaking, it's going to work in the other domiciles, the other jurisdictions. But also there's the NAIC approved list of banks and trustees and all those different considerations. But they're all fairly universal. So if it works for one domicile, it generally works for the other domiciles as well. I just wanted to make sure that I put that out there instead of having people think that maybe a trust or a letter of credit is going to work in one domicile and, for instance, not another. So I just put that out there.
I was going to say, I don't have as much to add to the conversation. There are definitely nuances that we deal with the regulatory process from the actuarial point of view, and the requirements are different by domicile. But generally, the actuarial requirements aren't going to rise to the level of all the other issues that have already been brought up.
Yeah, Lauren, I would also add in, and I didn't mention this, and we haven't necessarily discussed this, but there's perception issues as well. So one of the things that we've seen with tax-exempt or not-for-profit organizations in the U.S., historically, tax-exempt or not-for-profit hospitals have gone to the Cayman Islands. We now see perception issues with doing that and it could even be a for-profit business. And I think Cayman, I think Bermuda, I think Hawaii are all fantastic domiciles, but they also have a perception about it, right? Is it a bit of a junket? A getaway trip, a free trip to a great place. So those are considerations that need to be factored in here. They all have their positives and they all have justifications as to why they make sense. But we have to keep those into the discussion as well.
Yeah, I think, sorry, Laura, I just want to jump in here. I mean, the perception issue is huge in the sense that when we first started talking about Labuan vis-a-vis captives, nobody knew we had captives when we already have 40 Malaysian captives. So it's really quite interesting for us to look at the developments in Europe about the nationalization of certain captives within Europe. So you've got your France, you've got your Germany, you've got your UK, trying to become onshore captive domiciles for their own MNCs and large entities. And I think it's quite interesting that Labuan, for a fact, has done the opposite. So we started out having only Malaysian captives. And then now we've got more, we've got more and more non-Malaysian, more Asian captives. And what we're seeing now is actually a lot of European and LATAM-based MNCs and large corporations with huge Asian outposts looking for an Asian domicile. So it's quite interesting when you start looking at reputation. And again, I go back to that issue of being full service jurisdiction. I think the fact that you're a full service jurisdiction with, like, for example, we've got 50 banks, right? So when we first started going out to Japan, nobody expected to be able to bank in Labuan because nobody could bank in Micronesia, right? So it then kind of grows. It kind of grows in the sense that, oh, okay, so I can do all this here. And to Pete's point, yeah, maybe we could still play a bit of golf as well. That does always help. But yeah, it's interesting to note the reputational issue and the turnaround time. The turnaround time for a regulator is extremely important. We have a client charter that we adhere to, and sometimes, you know, especially with the onslaught of self-insurance vehicles coming through, sometimes it's hard to kind of manage everyone's expectations. But we try our best, and I think that is the bit that's important to understand. The reputation of the jurisdiction, the reputation of the regulator is paramount.
Yeah, just to add on, I guess, what Pete and Farah said, I think that, as you said, Pete, there is that real reputational issue that's becoming more and more important for many businesses. And I think there is this kind of perception as well about financial businesses in Bermuda and the Caribbean, and people kind of think back to some of the extremes they saw in the 80s, or, you know, some of the movies they've seen, and imagine that's what it's like, and it's not. So this nationalization is very, very interesting. But I guess building on what you said, Robert, you know, one of the many reasons a captive is appealing to organizations is the financial aspect. Like, while there is a long-term saving while investing in a captive, you know, financing your captive involves a lot of things, including having some cash up front. So looking at just that kind of dollar doesn't help. But I guess when people are at that stage and looking at collateral, what are the most important things to consider from your perspective, Robert?
Well, when it comes to collateral, thank you for the question. I think that what it really comes down to is the cost and the opportunity cost of the collateral that you're posting. You see, the two types of collateral that almost everybody posts are either letters of credit or trust accounts. And in the captive space, since captives are generally, I don't want to say shell corporations, but they're insurance subsidiaries of major corporations, but they're bankruptcy proof from the parent, generally speaking. And because of that, they don't really have many assets to use as collateral for a loan. And that's what a letter of credit is. It's effectively a loan. So when captives get letters of credit, they generally have to cash collateralize those letters of credit. So that's like collateralizing your collateral, which can be really frustrating for treasurers and risk managers of the parent companies and everybody else involved in the transaction too. Because letters of credit, in addition to being kind of expensive, I mean, if you're fully cash collateralizing a letter of credit, it could be anywhere from 50 to 100 basis points, or 0.5% to 1% of the value of the letter of credit just in annual fees. So when you consider the alternative, and the alternative doesn't work for everybody, you know, using a trust account isn't going to be ideal for every captive, but where it does work, rather than posting cash collateral for a letter of credit and having the letter of credit posted to the fronting carrier, you can simply place that same cash collateral into effectively a bank account and use that bank account as the collateral itself. And when you do that, it's not a loan, it's not a credit vehicle, it's really just a cash collateral account. So the savings can be astronomical. It could be 95% of what the letter of credit would cost you otherwise. Again, you have to kind of search out where that fits, because letters of credit do have their place in the industry. In fact, they have a very large place in the industry. But more and more, as we do letters of credit and trust accounts, I'm finding that the people who use trust accounts they're the ones who, like I said when I first started this, when people have time to make an educated decision, then often they make the best decision for their captive. And often that best decision is a trust account. It just has the perception, like we were talking about perceptions earlier about domiciles. Trusts have a perception of taking a little longer to establish, and they can take a little while to establish, but when you have the time, it's certainly worth the time. Yeah.
Yeah, Lauren, I actually want to ask a question to Robert, if you don't mind.
Yeah.
Are you seeing, and I'll give a little bit of background on this too, but are you seeing any sort of increase in the use of working trusts? So when we're looking at captive feasibility on the front side, whether it's deductible reimbursement or even with a fronting you run into the issue where you have your premium funding come in to the captive, which needs to be used to pay losses, right? So that's where you have, and then you have this additional collateral. So one of the things we've been trying to do is move more towards working trust. So essentially the premium dollars go into the trust. The funding's a bit higher than what a typical trust might be, but you're not doubling up on the dollars. So there's a bit more.
I've seen, I'm sorry, I didn't mean to cut you off.
No, that was it.
Okay. Yes, in fact, without favoring any specific carrier, I will say that the two that I've seen use what we call depleting trusts the most effectively are Zurich and AIG. They have working trust agreements that they put in place for specifically this purpose. And generally speaking, I can't say whether they're over collateralizing the accounts or not. The trustee usually isn't involved in the collateral amount discussion. We just hold the collateral when it comes in. But yeah, we see that really more and more often, to answer your question.
That's where Derek comes in. So we have him run the loss reserve numbers to me, and we use that to leverage back against the carriers. So
okay, yeah, and they're actually an incredibly effective way to do it, because when you post your collateral, and it doesn't just have to sit there earning interest, you can actually use it to pay claims, and it just bleeds down. And then at the end of the year during renewal, they figure out what your new collateral requirement is, and you top it up, and that's it. You have to renew a letter of credit. You don't even have to renew the trust. You just give it additional funding.
Yeah, it keeps replenishing each year based on whatever the renewal is.
Yeah. Right. Thank you for that.
Derek, like Pete mentioned, that's when you come into what what's your view, and what do you do when you're kind of starting off a captive?
Yeah, so when we talk about the financial considerations for captive owners to know as they get into the captive, from our point of view, this is often where they're kind of having to get into the shoes of an insurance company. And there are a number of things that come up from the actuarial reports that are just not intuitive in the non-insurance world. When we start off with the understanding what's going to go in for a premium, that premium is going to be based on those expected losses, but it's also some expenses. And we're also going to have conversations about some sort of risk margin or some sort of risk load for the fact that losses don't always come in at the expected in insurance. And for a captive, based on the capitalization they have, there might be need for more of a risk load there. So there needs to be enough there that it makes sense for your expected losses, some extra margin, and those expenses. And in an ideal world, whatever an insurance might cost in the traditional market, we think it would be very consistent in the captive. But understanding that those other different considerations, what is the right amount of risk load and what is the right expense level, those all play into why a premium might be higher or lower. And then also, of course, what a captive chooses to cover versus what they could actually get covered in the traditional market makes a big difference as well. When they look forward for the financial considerations and we move forward into the reserve analyses, the big thing for understanding is just an understanding of the way the losses will come in and the way they'll work. A lot of that will depend upon the structure of the program and the way the losses are covered. But oftentimes there's a kind of an educational component as we get to a reserve analysis and we talk about IBNR. And for an actuary, IBNR, incurred but not reported losses, is a favorite topic. But I always point out to all of our clients, IBNR, it is incurred but not reported. It does not stand for incurred but not really. And there's an understanding as somebody moves into the insurance realm and they have to, the idea that, yeah, there are losses that just aren't on the books yet, even when the policy's over, even several months after the policy's over. And that when we're certifying that and understanding that we can't rush just to close everything at the end of a year, that we're going to still, as the actuary, look back to a certain point in time, and we're going to say that there is something else that still needs to be held for those open claims or even claims that might still show up. So understanding that and the way that all flows into finances. It's just a different way of thinking about things where a lot of us who work in insurance day to day sometimes forget that it's not like anything else people work in their regular industries.
We've gotten a question in that is really relevant to the discussion right now. So I'm just going to put it forward now. And someone asked, how common is it to use the funds withheld method as collateral? So Robert, I'll throw that to you.
Thank you. Good. That's actually a very good question, and it's one that I struggled with for a long time. Why people would use a funds withheld arrangement? Kind of a convoluted analogy, but just to be clear, funds withheld is when, rather than posting a letter of credit to your carrier or posting a trust account that's funded with your corporate or your captive's cash, you simply give the cash to the insurance carrier to hold themselves. And that's the funds withheld. That's the collateral. And my convoluted analogy is that that's like asking the bully on the playground to hold your ice cream cone while you go to the bathroom at recess. You know, it's not that insurance carriers are bullies. I kind of got off that analogy for a while because insurance carriers aren't bullies. They're business people just like anybody. But I just don't understand why people would actually hand their collateral to the very entity that's going to take it the moment they need it. That's why you have independent third parties like letters of credit and trustees. Letter of credit providers and trustees don't have that much say in yes or no, should we give the carrier the collateral, but at least it gives everybody a moment of pause. And, you know, it kind of, you see what I'm saying. So we don't see funds withheld very often anymore. Funds withheld went away during the financial crisis of 2007 because a lot of the insurance carriers weren't doing very well financially themselves. And when you give your cash to the carrier, it comes off the books of the captive and becomes an asset of the carrier. So from an accounting standpoint, with insurance carriers not doing so well during the financial crisis, people stopped doing funds withheld. And it really just never came back into favor. And a lot of carriers don't like to do funds withheld anyway. So I hope that wasn't too long of an answer.
No, that was fantastic. Thank you so much.
Lauren,
look, we'll move. Yes,
do you mind? I'm going to go back just on the previous question you asked, which is sort of the overarching financial aspects of the captive. I'll try to be brief. So I think one of the first very important things is to know is you're not doing a captive for tax reasons. If that's your number one, forget it. That's not why you're doing a captive. And I think it's also very important. There are a lot of folks out there who sort of think, you know, my guaranteed cost premium is too high and my loss rate within that guaranteed cost premium is really low. So I'm giving a lot of money to carriers. So a captive is the answer. It's not necessarily true. And we're all here to represent the captive industry, but at the end of the day, and I think this is a consistent theme across this group, is it's to find the right solution. So the first part of the conversation should always be, what's the right optimization level of risk to retain, which, you know, Derek and his team help identify what that is. So it's, you know, how much am I paying in premiums? Where should I retain it? How much loss am I retaining? And what's my potential benefit? And what's the payback over time for doing that? So it's, that then aligns with a risk tolerance, risk appetite discussion, right? That all happens before you even look at the captive. You bring the captive in once you decide how much risk to retain, and then you finance it into the captive. And I think the other part, you know, Robert had his comments on collateral, which is the right collateral structure. But I think also, and this is a bit newer because of the hardening market and what that's doing to the insurance industry and how we've had carriers drop off. We've had forced increases in retentions. We've had increases in exclusions. Is the future of risk financing is going to be very different in 5 to 10 years, and it's going to be more involved with captives and those types of structures. So understanding where you're at today and that the captive is a long-term commitment, and that organizations need to start understanding where risk financing is going to be in 5 to 10 years so they can start moving there today.
Good point.
Lauren, can I ask a question to the three gentlemen, because I'm obviously the uninitiated here. You know, in 2020, a lot of businesses, like a lot of people, did not spend their money. So there's a lot of capital preservations within companies. Between that and a harder market, and trying to understand an entity's risk profile, what do you think is driving this growth in captives globally? Is it the fact that a lot of companies suddenly realize they've got all this capital and they might as well just put it into an entity like a captive? Or is it really this harder market? Or, you know, which combination do you think is really driving the market?
I have comments, but Robert and Derek, if you guys want to go first.
I was just going to say it's probably people like the three of you on the phone, Derek and Pete and Farah. You all make very good cases for when a captive is actually useful and honestly when it's not. And that kind of honesty and that kind of forthrightness goes a long way. People are establishing captives because it benefits them and not because it doesn't. But that was my comment.
I think you hit on a couple of the key points that leads to the surge in captives. The other one that I will also include in there is anytime we have events like we had this past year, this is also a realization moment where a lot of businesses thought things were covered that weren't covered. Or there are things that they now think they should be covered and there's no way they're going to get them covered. So it's going to take an alternative market of some form for them to find ways to cover them. But to your point about the capital, I think that's a good point as well. Pete made the comment earlier about you think the traditional market's too high, so you're going to go to a captive and you'll be able to do it cheaper. And there's a lot behind that, the risk management involved, and when somebody takes on their own risk, they do drive the costs down, but they don't drive those costs down in year one. And so I know with the number of captives I've worked with, some of the most successful ones, I know that their premium wasn't cheaper their first year in a captive compared to the market, but they've driven those costs down over time. And just like their premium might have not been cheaper that first year, there's a lot of expense just to do it. There's a lot of expense up front. So while a captive can be a great idea, there's still that kind of bump you have to get over to take that initial jump in. So I think the capital is a good point as well.
So Farah, I would kind of start back. You mentioned the events of 2020, right? The pandemic and what the implications of that were. The impetus behind the growth in the captive market started before that. Started in 2019 with the hardening market, right? We saw it in real estate, frame habitational, property, then GL, and then property and GL across all industries and then all lines, and it's just kind of expanded. We're seeing it in D&O, we're seeing it in umbrella and excess layers right now. It's kind of going through the whole thing. The view of it's kind of the same, but larger organizations see it a bit more. And really, because of the increases in premium pricing, where you're seeing 20 up to 200% increases, that gets attention internally within an organization, right? And whose attention does it get? The CFO. So typically it's sitting at the risk manager, and if your costs are fairly consistent year to year, then it's not going to get much attention. But when the risk manager has to go to the CFO and say, we need to increase our budget for this because this is what's going on, the CFO is thinking, should we be doing this differently? Is there a better way to finance risk? That has then been an impetus. So the hardening market and the insurance markets themselves are essentially pushing us forward into greater risk retention, not necessarily purposefully, but just in their reactions to the market and how things are going. So as soon as it gets the CFO's attention, the CFO is willing to look at things and say, should we retain more risk? And back to our equation is, what's my potential savings and how much more risk am I taking? And if I can save $1 million a year for 4 years, and once every 5 years I get hit with $2 million more with a cost, well, on a net basis, I save $2 million over 5 years. So the CFO then empowers the risk manager to rethink how they finance risk. And the captive is typically, not always, but is typically part of that solution. So that's been pushing the captive market forward.
Yeah, I mean, I've been speaking to, obviously, like I speak to a lot of risk managers all the time, as well as all of you and all the service providers. But I think as Pete said, the 2019, at the end of 2019, people were already looking at this. There was already increases in D&O. There was already increases in so many different policy lines. And then, yeah, I just think that the pandemic exacerbated it all. Because as you said, there were so many cases, both with people who had a captive and who didn't, on certain lines not having coverage that they thought they had. especially in relation to COVID. And that's kind of pushed a lot. And one risk manager I spoke to said, we already had a captive, so it meant we could add these things in quite easily and do these things because you can't get that cover in the market. But if we hadn't have had a captive that's been running for years, there's no way we could have done that. And I think that that's what's really hitting home with a lot of risk managers as well. Like, it's a long-term solution that will help you not just now, but 10 years into the future. We'll try and move on because we have gotten through quite a lot. But so we did speak a lot about the financial aspect. So when it comes to business plans and financial projections, what are the most important things for someone to know and that might impact them the most? Derek, do you want to start us off?
Yeah, regarding the plans and the financial projections, I'm going to kind of hit on some of the stuff I already mentioned before. But during formation, we're going to talk about where those premiums are coming from, and we're going to talk about the way those losses will come in and the way they'll roll off. Generally, we're talking about looking at some sort of projected financial statements, and so we'll want to make sure everyone understands that it all doesn't happen just in one year. The premiums come in the first year, but the losses are still being paid out years later. And so understanding the way that hits the financials and the way that'll show up, because there will still be cash flow until those losses are paid out and so forth. So making sure people understand that. When we talk about the financial projections and so forth during a formation, usually one of the big discussion points, and it depends on the domicile and the regulator for what they like to see, but is also we're also going to share bad news, and we're going to look at pessimistic projections, because despite what everybody thinks, insurance is not all roses and sunshine. There are bad stuff happens, and so we're going to talk about what those scenarios look like, and essentially kind of stress test what's been put together. So if that really nasty claim shows up in year 2 or 3, or the projections end up light compared to how heavy the losses come in, what's it going to look like, and how is the captive going to respond? So at some point there is going to be some discussion as well about, okay, what if everything doesn't happen like we think? And that's often a significant conversation as well.
Is there anyone else who wants to add to this that if something what we haven't already gone over, I guess?
I'd be interested, Farah, from the regulatory perspective, what you look for from the business plan and financial projections.
To be honest with you, it's hard to project in the beginning, because in a lot of instances when potential licensees come to us, they have an idea about the kind of risk they want to put into one of these vehicles. And then as they explore it further, it changes very quickly. And it depends on the underlying business. It depends on the underlying industry they're in. It depends on the geography. It depends on all sorts. So for us anyway, we ask for the barest minimum for the first AIP. And then as they come into operationalization, so what happens typically in Labuan is there's a pre-consult, and then you submit your plan. And that gets you an AIP license, an approval in principle license. And then the regulator will come back and say, fine, thank you very much. This is checklist. Go away and do all these things, and then come back to us. And then they will give you an operational license. And a lot can change between the AIP and the operational license, right? Because everyone goes in, and that's why it's called a plan, maybe, Derek, huh? It's a plan. And then as it evolves, it becomes very clear what's needed. So what happens is that then there's a check-in to see the kind of potential risk appetite, the kind of things that's been covered, and stuff like that. So when it comes to financials of the entity, we're quite clear. When it comes to the capital requirements and all the rest of it, that's very box standard. So that is the minimum that you have to adhere to. And it's because because it's in Malaysia, because we're extremely cost efficient, it doesn't cost that much to set one of these things up. But I think what a lot of entities are starting to understand is, number one, you can't have something without a proper plan. It's not a slap on, as I said earlier. And you know, if you start hitting a harder market and you think I want to get one of those, you're probably too late. So, you know, in order to really enjoy the benefits of your retained profits as contributing to that larger piece for your group. So with regards to financials, there are two bits, I guess, the financials of the captive and how they want to ramp up their capital, and the minimum requirements from the regulator.
So we have quite a few questions that have come in. So I'm going to switch to questions now, unless there's anything else that someone else would like to mention beforehand. All right, so we have one here that came in, which I think, you know, obviously Robert will be best, but management fees higher for a working trust as it is active?
Not generally speaking. It can be, depending on how actively the working trust is deployed. Usually it's monthly and it's a single payment going out to the carrier. That's not such a big deal. There are transaction fees, which they're like $15. So, I mean, it's not in the thousands of dollars more expensive. Generally speaking, trusts are more expensive the bigger they get, not the more working trusts they are.
That makes sense. So we had a question here. Do you see examples of when a parent might decide to set up a second captive in a different domicile? What would be the usual drivers for such a decision? I know there are examples because I've heard of them. But Pete, why would someone do that? Why would someone have two captives in different domiciles?
Believe it or not, there are any number of different reasons why. So if you take a global company, let's say a US global company with significant EU operations, and you typically are writing direct, then that US domicile captive, if that's what you have to start, can't write into the EU. So having an EU captive to handle those risks, which theoretically could then reinsure to your US captive and still centralize your risk. I'm actually working with a global manufacturing company right now that has a Bermuda captive, but based on the nature of some of the risk that we're looking in, there's a new program, very large, where we're going to have an obligor company. Well, if you have an obligor company and we put that in, say, Arizona, well, I probably want a captive in Arizona too, because it helps me avoid direct placement tax on that risk. So there can be different reasons to do that and to segregate the risks as well. So there can be any number of different reasons for looking at different domiciles.
Do you see that, Farah? Do you see some captives coming to you when it might be their second captive?
Absolutely, especially when you have a sell option. What they tend to do is come in as a sell and then convert. So they get their toes wet a little bit and, you know, check out the domicile. I think the other bit that's important to remember is that there's also a taxation and an ESR issue, not just a fronting issue that Pete was talking about. I think the tax issue, and this is something that, you know, as a non-insurance person, and a very tax-focused person generally, it's important to remember that, you know, taxation globally has made everyone very regional, because we need to meet ESR requirements in the jurisdiction that you have. So that's one other reason, and just to be closer to your market, just to be closer to your risk. So we're seeing a lot of European entities looking at Labuan now for their Asian operations. And we expect that to continue, actually. So yes.
So Derek, we've got a question here. How can a captive make sure that actuarial projections are not too conservative, which they might be? What's your advice on that?
I would tell you from an actuarial point of view, generally actuaries, when they're developing their expected losses, I would tell you are trying to shoot down the middle. It is natural in the insurance world to have a little conservatism, because we know that things tend to Jen, things tend to go worse before they go better. But also, when we talk about projections, sometimes it's having the communication and making sure you understand what's going into it and everything is documented well is how you can help make sure that they're not too conservative. I'll warn a little bit against the notion of things being too conservative at times. When we deal with coverages from an actuarial point of view, like a liability coverage or something, in general, most of the time you're going to have, or if things are priced well, you're going to have premiums that are higher than the way the losses come in, or reserves that are higher. But then a small percentage of the time, things are going to be worse. And it tends to be that when things are worse, they're a lot worse. So as an actuary, we're trying to get to a point where we think it is over time, it's going to even out. But generally, you hope that things are coming in better. It's just that that sometimes that they will be worse. As far as ways to make sure that you're not too conservative, I would say the same thing about being too conservative or being too aggressive. It's just making sure that there is some communication about the risk levels involved, and asking questions of your actuary. If there's a reason that it seems too conservative, asking for some explanation. There's definitely some reasons behind it, and if it's based on when a captive starts up, probably going to be looking at more some industry benchmarks and what else we see going on out there. But as a captive grows, talking to the actuary and about the ability to incorporate the captive's experience to the amount appropriate. Those are important conversations to have along the way, so that you do start to get credit for for better or worse, for how your captive is operating, for the way those losses are coming in and the way those loss ratios are coming in.
The next question we have here is saying, isn't the collateral level really a function of what a third-party reinsurer will accept, or what is the bank issuing the letters of credit will accept, or what the bank issuing the letters of credit will accept? Apologies.
Right. This is Robert, and there's actually two questions kind of hidden in that question, and I hate to be that person who says yes and no. I hate those answers, so I won't say that, but I will say this: the insurance carrier themselves, along with the captive, consulting with the captive and the actuaries and the captive managers and everybody involved, they define what the collateral amount is going to be. So if the insurance carrier says the collateral amount is $5 million, that's what the collateral amount is. Now, the hidden question in here, I think, is what they're getting at. If you are going to use a letter of credit and you have to collateralize that letter of credit, if you use cash, then likely you'll have to put $5 million of cash to back up a $5 million letter of credit. But if you choose to use like other types of securities like corporate bonds or, heaven forbid, stocks, equity securities, things like that, then they're going to ask for more collateral for the letter of credit just because those securities fluctuate in value. And the carrier or the letter of credit issuer wants to always make sure that the assets in the collateral account for the letter of credit are at least $5 million. So I think that's where that question is kind of born from. With the trust concept, it's really the same. I've been doing trust and letters of credit really for about 21 years now, and I've had every question possible that I can think of. What can you put in a trust? Jet engines, rail cars, thoroughbred horses, .com stock was always a good one. But the trust is a little more restrictive, and this is one reason I say that the trust doesn't always work for everybody, because the letter of credit could be more flexible in what you can invest in. The trust has regulations according to the New York State regulators, and therefore everybody follows it. So generally speaking, trusts are U.S. corporate debt investment grade. Having said that, if you want to use a bunch of A-rated corporate bonds, again, the insurance carrier, since they're the beneficiary of this trust, they're going to ask for a little more collateral as well. So in summary, the carrier defines how much the collateral is. What you put in the collateral account for the trust or the letter of credit, that might make your collateral requirement increase a little bit.
Thank you. That, as you said, like it's kind of two questions in one. So we have 2 left here, and we only have 2 minutes, unfortunately, so I don't think we're going to be able to get to them. They're both anonymous, but if either of those people are still listening, please, I'm sure you can email anyone on our panel and they will be able to help you out and talk you through some of the things. So I just first want to thank you all so much for coming on this. I think we had a really great discussion. And thank you to everyone.
Thank you very much. Appreciate it.
Thank you.
Thanks, everyone.
Thanks, everybody.
It's been fun. Thank you.